Generative AI is going to be a really hot sector. The way the stock market works is that when a hot sector rolls in, lots of companies will try putting themselves in a position where they can attract capital flows from investors looking to invest in the hot new sector. In today's video, we're going to discuss a recent short report by a short seller named Kerrisdale Capital, which claims that a company named C3.ai has done exactly this: dressed themselves up as a generative AI company and used questionable accounting to beef up their income generating strength. Full disclosure, I don't own any stock here and I'm not short. I have no affiliations to anybody involved, but I like looking at these reports because they are typically written by smart analysts, and from a learning standpoint, there's things to learn here. Before we get into this one, I have to warn you, I read the report and it's really long. I think that's partly to scare retail investors into selling their shares, which may or may not be for Kerrisdale and their network to cover their short into that selling. So whether you're long or you just want to learn, take a deep breath and look at the report with me. Decide for yourself, is there enough there? Okay, so this company started as C3 Energy, working on data analytics for public utilities, chasing areas like the smart grid, demand management, and cap and trade. But as Kerrisdale alleges, Tom Siebel, the company's founder, always wanted to put the company in areas where risk capital was flowing. So the next thing we know, they transform into C3 IoT, which was a major investment theme in the early 2010s. During this era, I recall going to small cap investment conferences, and there were dozens of companies raising money, claiming that they were doing things in the area of internet things. The odd thing was that most of the CEOs I talked to couldn't really explain how they made money other than repeating the words big data. It was as if they had a sticky user platform like Facebook to sell ads on. But as the report goes on to say, the Internet of Things was a somewhat amorphous investment theme and slow to develop. So what did C3 do next? They put on their fanciest AI costume, they changed their name to C3.ai, and they declared themselves the enterprise AI company. And the cherry on top, they snagged the stock ticker AI on the NYSE. Talk about commitment to the role. This report reminds me of how during the dot-com era, software companies used to acquire distributors to get low-margin top-line revenue and then try to convince investors that the distribution sales were the same thing as software sales. In other words, buy companies at cheap multiples and try to tell the market you deserve a higher multiple.
This is called Crimson Sky. What do you think?
I've broken this report into three main areas of concern that I think are worth highlighting. First, Kerrisdale holds back no punches on the company's business model, their low customer success rate, and how they're really just feeding off a low-hanging fruit consultant market, which is like stealing candy from a baby. Secondly, Kerrisdale claims generative AI doesn't really even fit into the business model that C3 currently employs. And thirdly, for those of us who like numbers, there is some alleged accounting wizardry going on here, and I want to get into that. So the report highlights how C3 promises an all-encompassing platform to cure the gamut of IT ills. The report highlights the practical reality that the C3 solution is difficult and expensive to implement. It claims that the C3 platform has been operationalized to address a limited set of applications and is prone to failure. For example, Kerrisdale claims that even in situations where C3 had a previously developed application, customers found that it always required lengthy and expensive customization before that application could become fully operational. According to Kerrisdale, C3's AI capabilities are underwhelming at best. The company relies on multiple open source tools, which contrast sharply with purpose-built native AI machine learning platforms like Palantir. They suggest that C3's applications are far from representing a fundamental advancement in machine learning, with quotes from former employees and customers who had harsh words about the company's AI, suggesting that there's no real AI at C3. According to the report, one anonymous former sales executive said, C3 was not designed to do AI from the get-go. There's no AI at C3. It's just a framework. They sell the capability to develop and deploy AI models, but the applications don't exist. They are just marketing positioning. There is a lot of AI technology in the market that is absolutely brilliant, but C3 doesn't leverage these advancements. They are way behind the times. I don't think they can catch up. It's important to note that Kerrisdale doesn't name this person, and they are a former employee. So remember the words of Brian Flanagan from the movie Cocktail when reading these quotes.
Jesus, everything ends badly. Otherwise it wouldn't end.
So, I mean, put as much stock into an anonymous former disgruntled employee shitting on a former employer as you want. Kerrisdale also claims C3 has little to no presence within the online developer communities, and that the company does not provide developer documentation to the general public. Its blog posts and videos targeting the developer community are uninspired. The report notes that the developer communities for competitors like DataRobot and H2O.ai are much more active and engaged than C3's. I don't find this part of the report particularly meaningful, and I will chalk it up to, let's add more words. Let's hope all these words freak out retail investors when they see the length of this report and they sell their stock. Seriously, the blog posts and videos are uninspired? Sounds like Kerrisdale was uninspired when finding more words to add to this report. Another thing Kerrisdale finds concerning is how C3 targets projects usually delivered by expensive consultants such as Accenture, Deloitte, McKinsey, and the Boston Consulting Group. These consultants have a reputation for difficult and expensive bespoke IT implementations with high failure rates. However, C3.ai itself struggles with similar challenges as its platform implementation largely mirrors that of a traditional IT consulting project requiring extensive use of professional services personnel. Okay, this is true. Consultants are often better at telling you how they can consult than actually consulting. Consulting is often seen as a hustle. The question becomes, does C3 eventually run out of ponds of clients to go fishing in that's full of potential consulting gigs? The report also points out that C3's major cloud partners, Microsoft, Google Cloud, and Amazon Web Services, are also competitors in the space. These giants offer data warehouse capabilities accompanied by their own powerful workbench of AI tools to target a wide assortment of enterprise analytics. Now, I think that this can be said of all small and mid-cap companies that are doing things in AI. They are competing against giants, with the best engineers in the world working towards enterprise solutions. This concern shouldn't be new to anyone who is long. They should be well aware of this risk, or else they are dumb.
So, you're dumb.
Now, before we go any further, you might be asking, what is generative AI? In simple terms, it is artificial intelligence that creates new content, whether that be in the form of images, text, audio, or whatever. Whereas traditional AI was used to recognize patterns and make predictions, generative AI is basically the next step in developing our robotic overlords. And thus far, C3's generative AI offerings appear to be anything but generative. To date, the company has indicated that they intend to produce a generative AI search tool, but Siebel is unsure how the company will monetize it. After all, it doesn't play well into C3's current enterprise AI offering, Kerrisdale tells us. They say that current generative AI models are not intended to analyze data and cannot improve the quality of analytic outputs. Early reviews of such models, in fact, have demonstrated that the models continuously provide false facts, cannot solve basic algebra problems, and are remarkably good at producing convincing arguments that wrong information is actually correct. Well, C3 said they intend to use both ChatGPT and Flan T5 models in their tech. This inherent problem makes the use of the tech rather, well, pointless. And as far as C3's proposed search function, reports indicate that generative AI search is simply not commercially viable, with the computing power required equating to 2 to 3 cents per query. Instead, Kerrisdale suggests C3 uses the term generative AI for the purpose of flogging the stock price, saying it's straight out of the stock pump playbook and the press release contained virtually no substance. An emphasis of this, a line chart comparing the search trend for the term ChatGPT and that of C3's stock chart was laid out, and quite frankly, that chart is fairly convincing. The last part of the report that I want to touch on is the gross margins. The report highlights that C3's gross margins appear overstated due to the Baker Hughes arrangement. Though the company's total gross margins for the past 2 fiscal years align with SaaS averages, this is probably the result of recognizing both subscription and professional services revenue from Baker Hughes at a 99 to 100% gross margin clip. Excluding Baker Hughes revenues, C3's other customer revenues generate mid-60s gross margins, which is well below the average for SaaS companies. Furthermore, C3's inflated gross margins are at risk due to declining Baker Hughes revenue commitments and potential customer dissatisfaction with expensive professional services. They also discuss how the company has $88 million of unbilled receivables, representing 61% of total accounts receivable. Now, of course, unbilled receivables are common in accounting fraud cases. A couple of points here. If you are an investor who is a fiduciary for a pension plan or something, you probably should be aware of these things. They should stand out to anyone looking at the statements. But if you are a fiduciary for a pension fund, you probably shouldn't own this company. Just my opinion, not investment advice. But I'd argue that if you are a retail investor looking to place small bets on speculative industries where you think capital is about to start flowing, these things shouldn't be a deal breaker. But I would add the caveat that the unbilled revenues part could eventually lead to a nasty write-off one morning, so you should probably pay attention to that risk. Let's talk about the company's response. Well, there isn't one. This means one of three things. Either 1, they don't think it's worthy of a corporate response. 2, C3 is working on a well thought out calculated response. Or 3, all the allegations are essentially true and the company doesn't want to acknowledge it. This brings me to the great Jim Chanos, who was one of the few respected short sellers by the mainstream media. When asked about how companies respond to short reports, he said,
one of the gold standards was what Reed Hastings did a number of years ago to a bare thesis, where he just rebutted it point by point, thoughtfully, without recrimination, saying, well, we think he's wrong because of this. And I had that happen to me years and years ago as a young analyst, when I had put a short recommendation out on a well-known company back when I was in the sell side. And the company actually invited, very rarely do companies invite short sellers to come to see their operations. And the CEO invited me out to where they were and spent the day with me and with his CFO and thoughtfully rebutted what I believed. I think I was right on about half of it, and I think they ended up being right on about half of it. But that is always a far better approach than saying these are outrageous lies, and then you don't address them. Because at the end of the day, if you have this sort of Clinton-esque non-denial denial, and companies are very good about that, they'll say, well, this is a gross exaggeration, or this is a, and yet they won't address the actual points of what the short seller is alleging. Then you're opening yourself up to further scrutiny, I think. And having opinions about facts is what makes markets. We don't put out big reports. That's not our business model. I'm happy to post things from time to time if we have observations, but we don't put out 40-page reports on short candidates. But I defend the right of any short seller to do that, as long as you are basing your opinions on facts and you're not knowingly misstating the facts. That standard applies to both bulls and bears.
Of course, comparing Tom Siebel to Reed Hastings is categorically ridiculous. That being said, if Tom is the salesman that Kerrisdale says he is in the report, Tom actually might win a battle in an open forum versus Kerrisdale. I digress. Overall, I didn't think this report was that damning. What short reports typically need are pictures that freak people out, like a picture of a cannabis facility that was acquired for hundreds of millions of dollars that looks like a shed full of rat shit, or pictures of invoices showing a company's sales are all non-binding. This report mostly focused on looking at the company from the lens of an investor playing on the part of the risk curve that most retail investors in C3 aren't playing on. They ought to know there are hairs, but don't really care that much, because they should understand that playing on this part of the risk curve is more akin to gambling than investing. Now, I bet if you looked at Canopy at $2, you would have found more hair on it than a group of hipsters at a Lord Huron concert. Lots of sophisticated investors saw those hairs and they still went long. Of course, Canopy eventually saw highs over $70. But now it's back to where it started. That's risk capital. It's not about discounted cash flows, freaking out over accounting policies, or even getting upset about uninspired blog posts. Who's to say C3 can't surf these waves? I'm not betting on it, but if I were long, how much would this report have swayed my opinion? Not much, other than the damage it would have done to the pump, which actually could be significant. That answer will likely come in how the company responds over the next 6 months with adding quality news flow to the story. But who knows? If they can't think of any news flow, maybe they can use their generative AI to think of some. All right, everybody, thank you so much for watching. If you could do me a big favor, please hit that like button, subscribe, ring the notification bell. Let us know what you think in the comments section. I love you all.